Okay, so from day one, we're pretty much all taught that debt is the ultimate enemy, right? Like a trap you have to avoid at literally all costs. But today, we're unpacking a massive paradigm shift. It's a shift that completely flips how we look at one of the most misunderstood concepts in all of personal finance and business. We're going to look at exactly how debt is used, not as this heavy burden, but as a super powerful, calculated financial tool. So buckle up, because this explainer is going to fundamentally change the way you look at money.
Okay, let's dive into this, because it's kind of the ultimate financial paradox. On one hand, you've got the reality for most average earners, right? They spend their entire lives running on this treadmill, trying desperately to just escape debt. But then, on the exact opposite side of the spectrum, the world's wealthiest investors and business owners, they're running a totally different playbook. They deliberately borrow millions of dollars. Seriously, why on earth do they actively seek out the very thing everyone else is running away from? Well, it's because they understand that not all debt functions the same way.
So here's what we're looking at today. We're mapping out 6 distinct ways smart money uses structured debt as a productive tool. 1. Income-producing real estate. 2. Expanding profitable businesses. 3. Accessing cash without selling. 4. Using other people's money, or OPM. 5. Assets that pay off debt. And finally, number 6, inflation and fixed-rate debt.
All right, let's jump straight into number 1, income-producing real estate.
This is your classic wealth-building playbook, where investors use debt to control massive assets for just a tiny fraction of the upfront cost. Imagine you've got exactly $100,000 in cash, just sitting in your bank account right now. You basically have a monumental choice. Option A, you take that entire $100,000 and buy a single, smaller property outright. All cash, boom, done. Or option B, which is a bit of a leap of faith, you use that exact same $100,000 just as a down payment, and you finance the rest of a much, much larger purchase.
And this brilliantly illustrates the crazy difference between those two choices. Let's just walk through the math here. If you go the cash-only route and buy a $100,000 property, a 5% increase in that property's value gets you a $5,000 gain. Pretty straightforward. But hold on, let's look at the finance route. You use your $100,000 as a down payment, you get $400,000 in bank financing, and you buy a $500,000 property. If that larger asset appreciates by the exact same 5%, your gain is $25,000. Your original $100,000 just generated 5 times the profit, literally just because of how you structured the capital.
That incredible amplification? That's the mathematical magic of leverage, using borrowed capital to increase the potential return of an investment. But we've got to look at the whole picture here. Leverage is notoriously a double-edged sword. Yes, it can massively amplify your profits, but it simultaneously and brutally magnifies your potential losses. If that $500,000 property drops in value, your losses are based on the full $500,000, not just your down payment. Plus, if your tenant moves out or, the roof caves in and rent suddenly doesn't cover your mortgage, taxes, and maintenance anymore, you, the investor, have to personally step up and cover that difference right out of your own pocket.
Which brings us to a massive mindset shift. Wealthy investors don't just sit down at a bank and ask, hey, can I get approved to borrow money for this? No way. Instead, they obsess over one very specific question. Does the asset produce enough cash flow to justify the debt and its risks? They are running the numbers rigorously, constantly stress-testing the investment to make absolutely sure the property itself generates the consistent cash needed to handle the inherent risks of taking on a mortgage.
Moving right along to strategy number 2, expanding profitable businesses.
Because, look, real estate isn't the only place debt goes to work. Imagine a local manufacturing business, right? They've got incredible consistent demand for what they make, but they are totally bottlenecked by old, slow machinery. If the owner decides to wait 5 long years to save up enough cash to buy new equipment, they're probably going to stall their momentum and lose market share to competitors. So instead of waiting, that business might borrow capital to expand today. They take out a commercial loan to rapidly buy additional equipment, maybe open new locations, purchase inventory at scale, hire more employees, increase production capacity, or even acquire another business altogether. But let's be super clear here. Borrowing at an 8% interest rate just because you're chasing a projected 15% return, that is never a sure thing. Smart owners weigh those expected returns heavily against shifting supply chains, rising overhead, and the very real possibility of an economic downturn.
All right, number 3, accessing cash without selling. Now this is a really fascinating maneuver, mostly used by folks with large, established investment portfolios. When high net worth individuals suddenly need serious liquidity, say to fund a new venture or pay for a huge expense, their first instinct is almost never to sell off their best assets. Why? Because selling means triggering a massive taxable capital gain and completely cutting off decades of future compound growth. So they borrow against their eligible assets instead. But listen, this isn't some magic cheat code, and it is definitely not free money. It requires intense, daily management. They have to strictly manage the total amount they borrow, the quality of their collateral, fluctuating interest rates, their required liquidity, and of course, the possibility of a market crash. If the stock market corrects and their collateral drops significantly, the lender can issue a margin call that forces the borrower to immediately cough up more cash, or worse, forces a panicked sale of those assets at the exact bottom of the market. It's a high-wire act for sure.
Which leads us to strategy number 4, other people's money, or OPM.
This right here is exactly how a visionary entrepreneur tackles a massive multi-million-dollar opportunity, like say building a commercial skyscraper without actually needing millions of their own cash sitting in a checking account. Let's break down this capital structure. A real estate developer might use a small chunk of their own personal funds, pair it with heavy senior bank financing, and then bring in outside investor capital to bridge the gap. Boom, a relatively small personal investment now controls a towering commercial asset. But contrary to whatever you might hear online, this isn't about recklessly borrowing as much as humanly possible. Responsibly structuring OPM means managing immense compounding pressure. Banks expect absolute non-negotiable repayment. Private investors demand high reliable returns, and your operational partners require complete transparency. The legal and financial consequences of mismanaging this structure, it's pretty much total ruin.
Okay, halfway there. Number 5, assets that pay off debt.
This concept is perhaps the biggest line in the sand between productive debt and destructive consumer debt. Think about taking out a hefty loan to buy a brand new, depreciating luxury car just for your own weekend enjoyment. That is literally money draining out of your checking account every single month. Contrast that with using a loan to buy a robotic assembly line that instantly lets a packaging business double its clients. So the crucial point is the defining query every single financially sophisticated borrower asks before signing anything. Who is actually footing the bill? Who is ultimately paying this loan?
If the answer to that question is paid by my personal salary, well, you've willingly put yourself in a pretty vulnerable situation. Your personal daily labor is solely responsible for servicing that debt. If you lose your job or get sick, guess what? That debt still demands to be paid. But, and this is a huge but, if the answer is paid by asset cash flow, you've engineered a completely different financial reality. The wealthy aim to acquire an asset, like an apartment building or an automated car wash, that actually steps up, generates robust revenue, and essentially pays off its own debt, totally independent of the owner's personal time.
And finally, our last strategy, number 6, inflation and fixed-rate debt.
When you use it strategically, predictable, long-term fixed-rate financing acts almost like financial time travel. It creates a phenomenal advantage thanks to the realities of inflation. Let's just follow a 20-year timeline here. Imagine taking out a $500,000 commercial loan locked at a fixed interest rate in year 1. Fast forward to year 10. Inflation has naturally risen across the economy, right? Which means the general purchasing power of a single dollar has dropped. Now look all the way out to year 20. The income generated by your underlying asset, like commercial property rents or raw business revenues, has steadily increased to keep pace with those 2 decades of inflation. But your original monthly debt payment, it remained frozen in time. It is exactly the same as it was on day 1. Over decades, inflation quietly reduces the relative burden of that fixed debt payment while your assets' income grows, widening your profit margin significantly.
So after looking at these 6 distinct frameworks, you can really see the big difference between good debt and bad debt. It's a massive line in the sand. And to be perfectly, absolutely clear, the takeaway of this explainer is definitely not rich people use debt, so everyone should blindly go max out their borrowing capacity. No way. That is a fast-track recipe for disaster. The real goal here is deeply understanding the mechanics of debt when it's meticulously used for productive purposes, always armed with a clear mathematical exit strategy.
Because the best investors in the world, they don't just sit around calculating their potential best-case scenario profits. They relentlessly plan for the absolute worst by asking, what happens if I'm wrong? They obsessively model out disaster scenarios. What happens if interest rates suddenly spike? What if commercial property values plummet? Or if their business loses its biggest client? Or, heaven forbid, an entire sector crashes and their income just vanishes overnight.
And that brings us to the ultimate, non-negotiable rule of this whole explainer. Debt is a multiplier.
It acts exactly like a fulcrum on a seesaw. It is pure mathematical leverage. If the investment works out beautifully and your foundation is solid, leverage will dramatically and rapidly amplify your results. But if you miscalculate, or if that economic foundation cracks, that exact same leverage will brutally amplify your losses, wiping out literally years of hard work in a matter of months.
So, now that we've peeled back the curtain on exactly how these financial tools work behind the scenes, I want to leave you with a final provocative thought. Looking at your own financial journey, your specific goals, and your deeply personal tolerance for risk, would you ever use structured debt to try and accelerate your wealth? Or does seeing the unforgiving mechanics of leverage make you want to stay completely and forever debt-free? It's a lot to think about. Ponder that for a bit, and we'll see you in the next explainer.